A flash crash is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And Guggenheim is warning investors to fade the rally as stocks are about to drop. Let's over to Yahoo Finance, where we picked today's story up. As the stock market is poised for a swift 20% sell-off by mid-October, with a recession increasingly likely, according to Guggenheim's Scott Menard. Investors shouldn't get too excited about the recent rally in stocks, as a big decline could be on the horizon, according to Chief Investment Officer Scott Menard. In a Thursday tweet that we'll look at momentarily, Menard pointed to poor seasonals and elevated valuations amid a period of high inflation as a reason to believe that the S&P 500 could crash 20% by mid-October. Menard followed up with his tweet with an interview on CNBC to further expand his views. It's really stark to see the price-to-earning ratio where it is, he said, highlighting that the current trailing price-to-earnings ratio of the S&P 500 is 19 times. Since 1960, when the core PCE year-over-year was 4 to 5%, as it is today, the S&P 500 PE ratio traded lower at 15.2 times. That difference makes out to a 20% decline in stock prices, which could happen very quickly. He says, quote, if historical seasonals mean anything, alluding to the fact that the stock market has entered the worst time of the year. And that's a big concern now, because investors, as we head into the fall, we notice the trading volumes are lower, demand is lower, and that means poor seasonals could send stock prices tumbling much lower. And now let's take a look at this chart that he provided from Guggenheim. And here you can see that the valuations should be closer to 15.2 is what he's suggesting, and that means stocks come crumbling down. And is he right? Does high inflation cause a problem here? Well, let's take a look, because we've got the non-financial corporate business earnings before interest and taxes in blue against the consumer price index on a year-over-year rate of change in red. And what we can note is that there are periods where inflation goes rising higher, and you can see that going into the great financial crisis, and that put downward pressure on earnings. So higher prices didn't lead to higher earnings, and we see here rising inflation, earnings come crushing down. Here we see high inflation. And what is the broad belief is that these high prices are going to be passed on to consumers. But what actually happens is consumers reject them. That means corporations have to discount, and that means lower earnings and lower stock prices. Given where seasonal are at and how far of line we are historically with the current PE, we should see a really sharp adjustment in prices very fast. And not helping Menard's outlook is a view that the economy is likely already entered a recession, and that's being ignored by most investors. And given the recent strength of the last few days, it appears people are ignoring the macro backdrop, and that is true. Monetary policy backdrop also true, which would basically indicate that the bear market is intact and arguably is in the beginning phase. We may be very well already in a recession. He says, I don't see earnings picking up dramatically. I actually see some downward pressure on earnings coming out of the energy and other sectors where we've had price declines. And here you can see in this chart, there's absolute evidence of this, because what we're now going to look at is the Fed's balance sheet against corporate earnings. And we can note that this week, on the 15th, the Fed is going to double the pace of its quantitative tightening to $95 billion. Many people said QE caused stock prices and earnings to go up. Well, if that's the case, then QT must send stock prices and earnings down. And let's take a look to see if that is likely to happen. And sure enough, you can see as soon as the Fed starts doing QE in 2009, notably, against corporate earnings shown in blue, we have in red the Fed's balance sheet or monetary base. You notice the two have a very similar relationship. As the Fed's doing more QE, corporate earnings are rising, the Fed slows down the pace and actually contracts its balance sheet a little bit. Earnings come down, the Fed ramps it up, earnings go shooting higher, and now the Fed's in unwind mode, telling us that earnings are indeed likely to come down. And oil prices in particular have been slammed in recent months, with WTI crude falling 31% from its June peak, as ongoing strength in the labor market and a healthy consumer may have kept many investors from declaring we're currently in a recession, instead holding out hope that a soft economic landing is still possible. And that's something we see all the time, is that people are saying that, hey, the labor market is strong. But as we've shown on this show, the labor market is a lagging indicator. It's the last shoe to drop. Employers don't just dump employees at the first sign of problems. they actually hold on to them, hold on as long as they can, and then when it's clear that demand is falling, so too do the ranks of the employed. But we can tell that oil is telling us a key factor here is it's suggesting the global economy is indeed slowing, and that means for stocks, they're likely to head lower as we look at this chart here with crude oil prices, West Texas Intermediate against the total U.S. stock market or Wilshire 5000. In red now, both on a year-over-year rate of change, and you can see the crude oil in blue as it comes down tells us that the stock market is likely to head lower, and you can notice they're fairly tightly linked, and the reason is simple, is because the U.S. stock market is the economy. As demand goes down, so for stocks, so too for oil. And Don Menard, who looks at other factors like productivity, he said it's been abysmal and we're getting more people back to work, but we're actually seeing a decline in output per worker. The employment indicator is a laggard. As I suggested, we tend to see unemployment rise after the recession started. A lot of things people are pointing to are nominally positive, but at the same time, inflation is running so high that in real terms, these are actually negative numbers, and that's how we measure GDP, he says. And Menard expects the Fed to raise rates by 75 basis points later this month, which should dramatically reprice to shorten the curve and lead to it becoming fully inverted, a sign that has historically been a leading indicator of a contracting economy. All these factors give Menard confidence the S&P could trade in a range of 3,000 to 3,400 in the coming weeks, and that's when stocks will look more attractive to him. But the question is, will it be more attractive, or is that just the beginning of the bear market? Let's take a look at this chart to find out. And here you can see we've got the yield curve, the 10-year Treasury yield minus the 2-year Treasury yield in blue against the Wilshire 5000 price index. That one's shown in red and on a year-over-year rate of change, just so you can see what happens when there is an inversion. The curve steepens, which occurs when rates fall. It happens because the 2s fall faster than the 10s. Stocks get unwound, and you can see that happening over and over again. The curve steepens a little bit, stocks go down. The curve steepens, stocks go down. Curve steepens, stocks down. Curve not yet steepening, but telling us stocks are likely to head down. And one thing that shouldn't come crashing down with a rising curve is your portfolio. I'll put a link up here to Portfolio Shield and in the description below, because why are stocks the hot thing in the U.S. right now? Well, there's only one reason. And that's because the U.S. economy is a safer bet than dire Europe, as Goldman strategists say, as U.S. companies focus on domestic sales to drive performance, believing that the U.S. is an island to the rest of the world. Despite concerns that investors have about the U.S. equity market, we believe it offers greater absolute and risk-adjusted return potential than the recession-plagued European markets, they note. And investors concerned about economic contraction should own dividends, either via futures or individual stocks. Dividends offer exposure to the S&P 500 fundamental growth while minimizing exposure to equity valuation. And that's kind of the view, is always buy stocks, but notably, even dividend-paying stocks got crushed during the last 2 recessions and during the financial crisis. So the notable idea that they are a place of safety, well, not so true. But let's continue on. Because Costa and his team at Goldman are keen on quality stocks to score highly on metrics, including strong balance sheets, as well as stable sales and earnings growth. They expect the S&P 500 to get this, to close the year up at 4,300, or about 6% higher than Friday's close, assuming the Federal Reserve tightening leads to continued deceleration in U.S. economic growth. And in the reality of the situation, when the Fed tightens, and they've made it clear they want stock prices to come down, and if stock prices do indeed come down, that means inflation comes down. So the idea that stocks are going to defy the Fed, well, they've never done that before and probably not going to do it again. But one thing we can look at is U.S. household net worth falls the most on record in slumping stocks. Does this mean we're going to see a boom in the equity market? Well, perhaps not. Value of stock holdings sank $7.7 trillion in the second quarter, and consumer credit rose at the fastest pace since the end of 2001. As household net worth decreased by a whopping $6.1 trillion between April and June, or 4.1 after falling about $147 billion in the first quarter, our Fed reported on Friday. The back-to-back quarterly declines pushed the total down to $143.8 trillion, the lowest in a year. And the report also showed the checking deposits, or money people have in checking, savings, and money markets, soared to a whopping $4.9 trillion. And what we can see now is a question we're going to ask is, does this the catalyst of a boom in the equity markets and a boom in inflation? Well, I think we're about to find out the opposite is true. Let's take a look here at household net worth in blue, overlaid against the Wilshire 5000 price index, both shown on a year-over-year rate of change. And what we can note is that when household net worth is falling, it means stocks have further to go, as you can see, going to the dot-com bubble, the great financial crisis, and now. But what about inflation, you ask? Well, let's take a look, because household net worth, when it declines during periods of rising inflation, you can see here consumer price index now shown in red on a year-over-year rate of change, comes crumbling down. Here you can see household net worth falling as inflation's rising. With a lag, inflation comes down. Again, going into the great financial crisis, inflation screaming higher. Remember, this was a new normal. Household net worth tumbling, inflation came down. Here we can see the same thing. Household net worth falling as inflation's rising, telling us that what is likely to happen is that shock that our chief strategist Jeff Snyder predicts is going to hit the economy is going to hit at some point, causing the Fed to pivot. Perhaps all it is household net worth declining. We've seen stocks go down, haven't seen real estate. Perhaps the next shoe to drop. But if Menard is right and there's a flash crash, well, that'll just be the beginning, because when the curve steepens, a much bigger decline is coming. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.